Hey everyone, welcome back to Corporate Decoder, the place where we try to find out if companies are cooking their books or if they're just having a really rough quarter. It's been a busy time in the world of SEC filings, and today we're diving into Oaktree Specialty Lending Corporation's latest quarterly report. You know, the kind of report that makes you wonder if they're actually lending money or just collecting IS from a very large group of friends, because let me tell you, some of these numbers do a real roller coaster impression. Alright, let's get down to brass tacks. As of the end of December 2025, Oaktree Specialty Lending Corporation had total assets valued at over $3 billion, and their common stock is listed on the NASDAQ under the ticker symbol OCSL. Now that is a lot of zeros, but what does it really mean for the health of the company? Their investments at fair value tallied up to just under $3 billion. Now this is the core of their business, right? Lending out money and expecting it back with interest. But look here, the cost of these investments was over $3.2 billion. That means on paper at least they invested more than they can currently see reflected in the current market value. It is like buying a stock and immediately seeing its value drop before you even have a chance to sell it. Nothing to panic about yet, but something to keep an eye on. Now for the flip side of that coin, the company owes a significant chunk of change. They had over $665 million in credit facilities payable and almost $945 million in unsecured notes payable. That is more than $1.6 billion in liabilities. Think of it like this: if you borrow a ton of money to buy a bunch of houses, some of which aren't selling for what you paid for them, well, you are going to feel that pressure. Let's talk about the actual money they made from their lending activities. For the last quarter of 2025, Oaktree Specialty Lending Corporation pulled in over $36 million in net investment income. That sounds pretty good, right? But compare that to the same period the year before when they made over $44 million. So there is a noticeable dip there. It is like a restaurant having a great year, but then their sales drop 15 to 20% the next year. They're still making money, but definitely not growing. Now this next part, the net unrealized appreciation or depreciation, is where things get a little dicey. Instead of making money on their investments, they actually saw a depreciation, meaning a loss in value of over $32 million. This is a big deal because it means the market value of some of their holdings dropped significantly. It is like waking up and finding out that part of your investment portfolio lost a chunk of its value overnight. Looking at the statement of operations, we see total investment income for the 3 months ended the 31st of December 2025 was about $75 million, down from $86 million the previous year. Oaktree attributes this drop mainly to lower interest income. Think of it as interest rates falling, even though they've been high lately, which is a bit confusing, but it really comes down to the specific deals they have. More importantly, their expenses went down too, which is good, but the combination of lower income and a big depreciation in investment value led to a net increase in their net assets of only $5.6 million compared to over $7 million the year before. It is like saying, yes, we made some money, but a lot less than we planned. Now let's peek at their actual investments. This is where the meat is. They put their money into a staggering number of companies across various industries. We're talking about technology, healthcare, real estate, and even some more niche areas. This diversification is usually a good thing, spreading risk across many areas. However, if you look closely at the notes, you'll see a significant portion of their investments are categorized as level 3 within the fair value hierarchy. What does level 3 mean? It means Oaktree is using their own estimates and judgment to value these investments because there are no readily available market prices. This is like valuing a rare collectible base purely on what you think someone would pay for it rather than what it is actually selling for on an open market. It adds a layer of uncertainty. As of the 31st of December 2025, about 99.8% of their portfolio was valued using observable market data, meaning it is pretty solid, but the shift to those level 3 investments is something to watch. And guess what? Those level 3 investments saw a significant depreciation. The report mentions an $8.5 million depreciation in senior secured debt investments and a $11.1 million depreciation in common equity and warrants. That is a substantial paper loss. Looking at the level 3 investments, the fair value as of the 30th of September 2025 was about $2.4 billion. By the 31st of December 2025, it had dropped to just under $2.5 billion. So while their total investments grew, their level 3 investments experienced a notable dip in value. They have a massive chunk of their money tied up in senior secured debt, over $2.1 billion at fair value. This means they're typically first in line to get paid back if a company they've lent to runs into trouble. But even this safe haven saw a depreciation in value during the quarter. The document explicitly states a net unrealized depreciation of over $22 million related to these level 3 investments, still held at year end. This highlights the uncertainty of these valuations. Now let's touch on related party transactions because that is always a spicy topic. Oaktree Specialty Lending Corporation pays Oaktree Fund Advisors LC a hefty management fee, 1% of their gross assets excluding cash. That is about $7.5 million for just one quarter. They also pay a significant incentive fee which ties their pay to the company's performance. This structure can sometimes create a conflict of interest where the manager might be incentivized to take on more risk to get paid more. It is like a chef getting paid a bonus based on how much food they sell, not necessarily how good of food it is. The company also has a whopping $274.5 million in unfunded commitments. This means they've promised to lend out this money but haven't yet. It is like having a credit card with a large limit but only spending a portion of it so far. It is a potential future cash outflow. So what is the big picture here? Oaktree Specialty Lending Corporation is navigating a complex market. They're dealing with lower investment income and significant paper losses in their level 3 investments. Their strategy of lending across various companies and industries is standard for their business model, but relies heavily on Oaktree's expertise to manage those often hard. Value level 3 assets, they're also carrying a substantial amount of debt. While they seem to be complying with their loan covenants for now, the sheer amount of leverage combined with the valuation challenges in their portfolio does present a higher level of risk. They're making money from interest, but the fluctuating fair value of their investments is a significant factor affecting their overall net asset value. The continued growth in their loan originations is positive, but the real question will be how those level 3 investments perform when Oaktree needs to actually sell them. Investors need to be aware of the inherent risks in less liquid and harder to value assets. Alright, that is our dive into Oaktree Specialty Lending Corporation's latest filing. What do you think about these numbers and Oaktree's strategy? Let us know in the comments below. If you found this breakdown useful, please give this video a thumbs up and subscribe for more corporate financial deep dives. And hey, don't forget to join our Discord community linked in the description for even more discussions. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.